Case-Shiller Index is now showing 30% peak-to-trough decline. Clearly, the housing crisis has rattled the foundations of the domestic and global economies. Peter Schiff joins me today to discuss the implications of the housing fallout and related macroeconomic trends. Peter is president and chief global strategist of Europe Pacific and recently back from the island state of Hawaii. Probably searching for discounted beachfront property, huh, Peter?
I don't know. There's many discounts going on out there. I still think the property markets are relatively firm, in that part of the world. A lot of foreign money coming in.
Jennifer and I found a brilliant house there for $144,000 on the big island of Honolulu, just looking over the Pacific. Formerly priced at about $250,000 on realtybid.com.
Eventually, the dollar could just lose so much value that nobody will give you anything for them. So, obviously, if you debase money enough, prices will go up, even for stuff that's in abundance right now. Like real estate. There's a glut of properties on the market, but if there's a bigger glut of dollars, then property prices can rise, at least measured in dollars. Of course, they'll fall measured in everything else, such as gold.
Well, I'd like to kick off with the housing bust. You were early in on this trend, and your investors profited handsomely from bets against those dodgy subprime loans.
We actually have that many investors that did that trade. But yeah, we helped set up a hedge fund, and the people that got in on it made a lot of money as the subprime market imploded. Yeah.
It's an ironic twist here, but you actually worked for Lehman Brothers as a consultant. I've never asked you if this fact helped tip you off.
I worked for them, when Michael Milken was still there. This was in the late 1980s, so it was, that's after I left Drexel. No, it was right. But I was at Lehman right after Drexel failed, because I actually was at Drexel first. Both Wall Street firms that I worked for went bankrupt, but it took Lehman Brothers a lot longer. But when I worked there, it was in the early 1990s.
Well, first, the government gave us that $600 tax rebate. That wasn't enough. Next, it was cash for clunkers, car clunkers, and then on to cash for foreclosures. It's now rumored that $8,000 tax rebate will soon morph into a $15,000 rebate and be extended to practically everyone.
Unfortunately, for me, I ended up buying my first house, for my mom to live in, because I was renting her place, and so I bought a house. And I didn't get the tax credit because of my income, but now it probably is going to disqualify me for taking advantage of it if I were to actually buy a house for myself. All these gimmicks, it's all this stimulus, and it's not going to help the economy. The economy is in trouble because of all the stimulus. So the more they stimulate the economy by printing money, the worse it's going to get.
As far as your place is concerned, though, I'm sure you picked it up at quite a discount.
The property in Florida, it was certainly a lot lower than the properties we're selling for a few months earlier. But I don't think I got a great buy on the property. It was more of the fact that that's the property that my mother and her sister wanted to live in that community, and there wasn't that many houses on the market. So I thought the house was probably a third lower than it might have been had I bought the same property a couple of years earlier. But I'm pretty sure that property will continue to lose value. I didn't buy it with any expectations of making money. I bought it knowing full well that it was going to lose value. So it was more of just something that I did because it was convenient for my mom and her sister. I wouldn't have bought it if I thought I was to make money on it.
Sources are showing, though, that Florida, 50% of the mortgages there are either upside down or underwater. And the same group of analysts expect the United States to approach that level before 2011, when I think the housing bubble will have finished its downturn. Do you think that that's a reality? And did you see signs of that in the Sunshine State?
Yeah, certainly if we'd have bought down in the Miami area where, prices are much weaker than they were where I bought. But yeah, anywhere there was a lot of speculation, anywhere there was a lot of development, where a lot of condos were going up, where you had a lot of people flipping properties and where people were buying properties using all sorts of gimmick in the way the loans were done, interest-only loans, negative AM, option owns, zero down payment, stated income. That type of stuff was going on a lot in places like South Florida, up and down California, in cities like Phoenix and Las Vegas. And so in those type of communities, there's just, it's going to be a bloodbath. It already is, but it's just going to get a lot bloodier. There's a lot more properties that are going to come on the market over the course of the next year or two. And as the economies in those areas, which were so dependent on real estate wealth and real estate transactions, it's actually, it compounds the problem. Not only do you have falling real estate prices and more, foreclosures and properties for sale, but the impact on the local economy means you have a lot more unemployment, which makes houses even less affordable, and you have fewer buyers, and you have more people who are trying to get rid of their property because they lost their job. And so it just becomes a self-perpetuating spiral. And so prices could really, really get cheap in certain parts of the country. And in fact, they would already be a lot cheaper if the government wasn't propping up the housing market with cheap money and subsidized mortgages.
I think that's an excellent segue. I mean, speaking of unemployment here, now that typical spring home buying spree has passed, I think enthusiasm is going to continue to wane because, as you aptly point out, we're approaching 10% double-digit unemployment rate. We have a 9.8% at the last check. Add into the mix the options-only resets, the already glutted housing market, and a mountain of foreclosures. And I think that unemployment might just be the metric that we need to follow to look for signs of a bottom in housing.
I don't think there's going to be a bottom in housing for a long time because there's not going to be a bottom in the economy. The economy is going to keep getting worse. Unemployment is going to be worse, 3 or 4 years from now than it is today. So I don't think housing prices are going to turn around. But if they create enough inflation, then yes, nominal home prices might not fall. In fact, they might even rise. But in relation to something like gold, how much houses can be bought for a given quantity of gold, I think prices for houses are going to continue to plunge. In fact, I think people are going to be shocked at how much house they can buy, for 100 ounces of gold or 1,000 ounces of gold, compared to what those houses would cost today. So I still say, hold on to your gold. You're going to get much better deals when you trade them in for houses down the line.
Speaking of gold here, and I'd like to delve into that recent activity we've seen in the precious metals markets. I mean, just a few weeks ago, gold blasted finally through that former high of 1033. It's currently consolidating above support. And although the Fed keeps talking tough on inflation, this dollar downtrend seems to remain intact. Do you expect the weak greenback to send the yellow metal to $1,200 on this next leg higher?
Yeah, first of all, when you're talking about the Fed, they might talk tough on inflation, but they don't act tough. In fact, they create inflation. I mean, that's the irony of it. They're saying that there's no inflation in sight. Meanwhile, if they can't see it, it's because they're blinded by all the money they're printing, all the dollars, the inflation that they're in fact creating. And the Fed likes to talk tough, that they're going to contain inflation, but that's all it is. It's talk. There is no action. Their actions are the opposite. Their actions are they're creating inflation because they think inflation is the only way out of this predicament. Unfortunately, it puts us in an even worse predicament. But, for politicians, this is their only viable option because the alternative is to honestly admit how much trouble we're in and to allow the market to function and to allow, for all the pain associated with rebalancing the economy off of this bubble that was created by central bankers and other politicians. So I think they're going to keep debasing the dollar. The dollar hit a new record low, or not a record low, but a new low for the year early this morning before turning around here today. We had new 52-week highs this morning in the Swiss franc, in the Australian dollar. I think that the dollar is going to keep losing value. In fact, Brazil just announced yesterday that they're imposing a transaction tax on foreigners investing in Brazil. They're trying to stem the rise in the real, which has risen by 35% this year against the dollar, despite the fact that the Brazilian government has bought up tremendous numbers of dollars. Their foreign reserves now stand in excess of $200 billion. And you have foreign central banks all around the world creating inflation, trying to keep the U.S. dollar afloat. I think this is a very misguided effort on their part. Foreign governments would be much better letting the dollar sink than creating all this money to try to keep it afloat.